Hello everyone, my name is Deepak and with me is Sanjeev Gupta, CPA. If you guys don't know him, then there's a problem. That means you are not in Bay Area. So anyhow, a couple of updates. As you guys know, every year we do the Wealth Summit. So that's going to be happening on November 10th this year instead of being in December. The link to register is live. So you can go to sanjeevcpa.com and you can register there. And over the next couple of months, I'll be talking to everybody who will be coming to the Wealth Summit and what are they bringing to the table. So you will get to hear a lot more from them. But today, I have many questions that have been coming in over the last couple of months. This year, Sanjeev hasn't really spent so much time making videos or answering questions in a social way, although he was present at a couple of webinars, but he had to travel to India for some emergencies, and that kind of took a lot of his time away. I've been collecting those questions. As you can see, have a lot of those up here. So I'm going to try to answer some of them, and then over the next couple of months, I'm going to try to get as many answers. And I know because they've been collecting for last few months now, what I'll try to do is split the video into smaller sections, so that way you guys can find those answers on Sanjeev CPA YouTube channel. Now, if you have a question and you want me to bring that to Sanjeev attention, you know how to get hold of me. I have a WhatsApp group. If you're not part of that WhatsApp group, just reach out to me. I'm sure you can find me, right? You can go to sanjeevcpa.com. You can go to taxcodeadvisors.com. You can go to my WhatsApp channel, or maybe you know friends or family members. I'm not gonna put my cell phone number out here on the YouTube video, but I'm sure you can easily find it. But if you can't find it anywhere else, you can call Sanjeev's office 510-825-7563. Just let them know that you want to speak with me, and then they will relay the message, and I'll call you back and get your question answered that way. So a lot of different ways. But my recommendation always is, if it's a tax problem, then it makes more sense that you do a proper consultation, because any answer Sanjeev will provide today is very generic in nature. First of all, I don't have a complete question. You thought you sent me a complete question, but we might be missing some facts. So that's one. Number two, there might be some add-ons related to it. So that's another. And the most important part is, these are financial discussions, and the answers can have a huge impact on your outcome. Sometimes we're talking about hundreds of thousands of dollars. So we don't want to give you a wrong advice that can cost you a lot of money. So my suggestion is, go to sanjeevcpa.com, set up a consultation appointment, and get it answered that way. So anyhow, Sanjeevji, yes. Welcome. So today I have a lot of questions, but maybe I'll take 1 hour of your time and try to at least get 10, 12 questions answered.
That's perfect. And Deepak, you were talking about Wealth Summit. Of course, this is I think 12th or 13th Wealth Summit. We are doing this since 2012. This year I'm taking a different approach for tax planning, because I used to do a traditional way of this way, but I'm trying to give more input into the detailed tax planning strategy when it comes to investments, and also try to see what we can do, because a lot of people have a lot of RSUs and other things issues. So what we can do best way to counter that in a best tax possible manner. So we're going to look into that those strategies. So it's going to be unique this time from me when it comes to tax planning.
And not just from you, Sanjeevji. I think we told everybody else who's involved with the Wealth Summit to bring something new to the table, right? Yeah. I love it. Even if it's the same content, I personally enjoy it because I get to meet so many people. I get to learn from many of you guys. It's a beautiful event. Sanjeev makes sure everybody is well fed. There's a lot of food there, a lot of snacks there. So that's always fun. So anyhow, Sanjeevji, let's get to the questions, because I have limited time and then you need to get to work. So first question I have for today is related to a strategy that you discussed in last Wealth Summit, which was including kids in your business. Question I have is, I have a 5-year-old and a 10-year-old, so 5 years apart, 2 kids. How can I involve these kids in my small business?
It's a very good question. A lot of people ask this question. When it comes to kids, don't involve them. That age is very important consideration for doing tax planning. So 5-year-old can't even understand basic stuff about expenses and income, and it's not properly qualified. Even 10-year-old. So what is the age that you're looking for a kid? At least 13 plus. That age is an important age where people, the kids can understand few things about how they can help a business with their families, with their parents and other things. So 13 plus is the age where you used to start looking into for giving some kind of salaries or kind of 1099, depending upon the business income and what they are doing with you. For example, you might be taking them to the office. They must be doing some painting. Maybe clients are looking at them, smiling them. So they creates that aura in the environment for that. So you can give some money for them relating to that aspect. But you should keep proper documentation, proper record for the time they are spending and they're coming, and also make a brief note about what activities they're doing. So if they're helping you paint your car or pasting your sticker with your names, your firms or your business, you can take a picture of that and keep for record purpose. So age do matter. 13 plus is important age. After 13 plus, yes, you can start looking into it. Beware of the kiddie tax rules. So kiddie tax rules does not apply for earned income, means income that you give it on, which is subject to self-employment like W2s and 1099s.
And couple sense, this is a great example of generic tax advice. We don't know what kind of business you are in. You know, maybe you are a photographer,
Right.
and you have a 6 months old, and you are taking 6 months old pictures to
Yes.
promote your business.
Yes, that's
Right. We don't know that, right?
Yeah.
In that case, that would look like a legit business expense.
Plus the model, the image of the kid, and you're using that image for advertising. That's important area too.
Right. Another example I can think of is these days I meet Sanjeevji, a lot of kids are very tech savvy and parents are not, and they're running businesses, right? So if your kid is a tech savvy, maybe they're 10-year-old, for example, in this case, and if they can use proper computer, can they use Excel that you can't do, you know, or can they maybe manage your website or something? Like the way I look at it, Sanjeevji, is have a job description, what this job's supposed to do, and ask yourself, can your kid do it?
Right.
And if they can do it, then that sounds like more reasonable than you just randomly paying your kid. So
Yes, but one has to be very careful when it comes to, because you're looking from the IRS point of view. So from IRS point of view, they think the kid is not qualified. So you have to prove them wrong. You have to have sufficient documentation. Of course, the kid can be helping you in different manners. But the perfect example, like you said, was a photographer having the image of the kid and using that image for promoting their businesses, like Starbucks founder
sure.
is using that image. That's a way, but you have to also have documentation as to how you're proving to the IRS in case the IRS comes back why you're paying so much money or why this is there. So 10-year-old kid, of course, can qualify depending upon the income, the business they are in, but documentation is the key factor.
So there you go. I think that clarifies that. So let's move on to our next question. So Sanjeevji, this question is an interesting one. This one is related to real estate professional status.
Right.
So those of you guys who don't know what that is, it's a very great strategy to take paper losses that are generated from passive activity such as real estate and writing them off against your regular W-2 income. So normally that would not work because you have a W-2 income, which is an active income, and then you have this real estate losses that are passive losses. So you're kind of mixing apples and oranges, and it's not really a good fit. But if you can qualify as a real estate professional, that means you're saying, look, for me, real estate is not passive. For me, real estate is real. It's my real true business. That's how I make my earning. This is my primary source of income. You know, so you come out as, hey, this is my business. If it is your business, then IRS says, okay, if this is your business, then we will not treat it as passive and we will treat it as an active. So that strategy is really good. And we have several videos on that strategy, and perhaps I can kind of update you guys in another video going detail into it. But this specific question is related to a construction company. So this gentleman is a licensed contractor. Maybe he doesn't specify whether he's a electrician or plumber or whatever, but he's a licensed contractor, and I'm a salaried employee, so gets a flat fees Uh, Now, the only question is he also, see, this is the problem with these questions. He also doesn't specify he's a salary employed from his own company or working for somebody else, because that makes a huge difference in the way we can answer that question. So I'm going to assume for a second, Mr. Salaried Employee, that it's your own company, that you're working for yourself, and maybe you have an S corp and you're paying yourself a salary every single month. Um, he's saying, look, I don't have a punch card, I don't track my hours. Can I qualify as a real estate professional?
If it's in a construction business, see, the reason why the IRS looks at this IRS the real estate being a passive or active, like you rightly said, the losses can be used from the real estate generated from the paper expenses like depreciation, where you don't put anything, you get it. And that losses can be used to offset your W2 income. So W2 income is ordinary income. So you save 30 to 40%. If you're living in a state like California, you can save more. That's a big red flag that IRS in the system when it comes to real estate or any businesses. Like if you are doing a business, like I am a CPA, I am a professional because I run this business day in and day out. This is my bread and butter. Same thing it applies to real estate. You need to qualify for if you're relying on a real estate as a business, then it's a business. Your bread and butter should come from real estate. You should be spending time to make money from real estate, not real estate making money for you. So that's the thing. That's the difference that they have, and that's why they put the number of hours for long term, short term. All those things are there. This person is in construction business. Is doing construction on what? Is he doing construction on his own property, or is doing construction for others? If he's doing construction for others, of course he's a professional, but he's professional in that sense, not a real estate sense. If he's doing construction on his own real estate, which he owns, of course then he's a real estate professional. So he doesn't need to put that many hours. But if he's working as a contractor for other businesses, other real estate owners, then definitely is not a real estate professional. It's more like a construction business.
Yeah, I mean, at the end of the day, you are an employee, basically, who is doing some specific work to earn your living, but it's not coming from your real estate investments. That's not where your money is coming from. It's not like you purchase the land and you're building the building and then you're going to sell it and all that kind of. Another part to it too, when you start doing activities in that sense as a real estate professional, then they might not be treated as investment either, because now you're treating them as a regular business, like you're basically flipping in a sense, like you bought the property, you fix it, you flip it. That could trigger just like a regular ordinary income tax instead of what somebody else might treat it as a capital gain.
Right. Flipping the properties, doing upgrading to your properties, keeping it as inventory and selling it. So it's not a real estate activity, it's a business activity. So one has to be careful with respect to that area. When it comes to real estate, forming an LLC and putting that real estate in LLC doesn't mean a business. Okay? LLC is for protection. People come and say, I have a business. And when I ask this question, what business? I have own real estate. And of course, you own a real estate. What did you do? Oh, I put in an LLC. My attorney's advised me. Putting a real estate in LLC does not change the nature of the activity. The activity is passive, it's active. But you have to follow the rules and regulations and find out whether it's active or passive.
That itself could be like a one-day event, yeah. Right? That there's a lot can happen in that arena. And not in a bad way. Many times it's a good way. In matter of fact, Sanjeev is a good example of that. You know, maybe you find a partner who has a good business, and maybe you partner up with them, but you're not involved in the business. That will be a passive income. And maybe you have a real estate that has a passive losses. Now you have a great combination of that. So sometimes it works in your favor, but if you just rely on advice, in a general nature, then that can, come back and haunt you big time.
And Deepak, before you go to one more important point I want to point about the real estate, when you do your tax return on your own, when you use your tax software, any like TurboTax or Tax Act or whatnot, or you use a CPA who is not aware of the rules and regulations, well, a lot of time what happens, there are two schedules for real estate. There's Schedule E Part 1 and Schedule E Part 2. Part 2 includes income or losses from other partnership or S corporation that you have. So what is happening here is you don't look into that Part 1 and Part 2. If you have losses from real estate and you're active, you're not active, you're passive, and you have income from other businesses like partnership S corporation, they're clubbed together in part 2 of the Schedule E. And what happens is, if your losses from real estate, that losses can be used to offset the income. But if the loss is passive, it will not be able to offset that income. So just be careful on that Schedule E part 2, because that's again is a red flag with a lot of they look into this very carefully, and don't ignore that. Oh, I'm getting my income is set off from losses from real estate, I'm set. No, if it's passive, it will be carried forward. The income will be reported on your 1040 from other businesses. But if it's active, then it can be used to offset. So be careful on that Schedule E part 1 and part 2.
All right, my next question is what strategies you can offer to offset passive losses? Very related question. What else can he do to offset passive losses?
So passive loss is a very big word. Passive loss are different from stock losses. There are two schedules on 1040. Schedule D is for capital gains from sale of from capital assets, and there's a real estate carved out from there, separate out as a Schedule D. They put two different schedules, Schedule D and Schedule E, because they want to separate out the losses from offsetting one or the other, depending upon scenarios. It depends upon a lot of circumstances where you can use it, in some circumstances you can't use it. But generally, that's the logic behind having two schedules. Passive losses are, again, it depends upon whether active or passive or reactive or passive. There is a form that we use for capturing that passive losses. That form is 8582. That form is so important to look into, because it identifies all kinds of activities, whether with active participation or not. If you're active or not active, then it's do allow the losses or not allow the losses. It's based on that form. When it comes to capital gain losses, it's $3,000 you can claim against your W2 income, but that $3,000 does not apply to passive losses. It's based only on Schedule D. Okay, so one has to be careful with passive losses and capital loss. That's why these two forms are there. To offset passive losses, he has to generate passive income. And where he can generate passive income? Of course, he can invest in a syndication in real estate. He can invest in a business with other people, and then get a K1 from those areas. And if you have income and then he has passive losses, of course he can look into that, because there's a passive income and passive losses. He's not actively involved into that investment. He's not the decision maker in that business. He can use that way. Then look at any other passive income you have. People get confused with passive and investment income. Investment income are different. Interest and dividends are not passive income, they are investment income. So of course there are strategies out there for using that losses passive to convert it to active, but then you have to be careful with all regulations.
And because I hear this in consultations many times, is sometimes people think because they have a passive loss, they are in some sort of loss.
Yeah.
Remember, first of all, it's a paper loss most of the time. You're not really in a loss, right? That's one thing. And number two is, if you're not able to claim that loss, it still carries forward. So it doesn't disappear. Whenever, for example, if the loss is coming from a real estate property, whenever you will sell the property, those losses, you'll be able to capture them.
Yeah.
So I wouldn't really worry about too much. Even if you have it, that's okay.
Yeah, it's a today you are not taking tax benefit. In future you will take the tax benefit. So same thing with any kind of retirement planning like Roth IRAs. Today you will not take the tax benefit, but the growth can be tax free depending upon how you do it. So just compare with that one and see. So that loss is a valuable asset that can save taxes, not today, maybe in the future.
Exactly. So don't worry about it too much. I think at the end of the day, what you're really looking for is, how do I reduce my taxes?
Currently, that's the question. That's the current people who do ask. They are more worried about what to do to reduce taxes today. They don't think about long term. So we should be looking at planning for the long term, not for the short term. Because hey, right now you're making good money, very good money. Of course you will be paying taxes. Of course there are strategies out there, but there are high risk strategies there, which are very high risk, audit risk strategies, which are given by other CPAs, the tax professionals, and other they advocate for those strategies. But those are high risk. Why you go into all those things? You should be going into the strategy which can save you taxes as you move forward.
All right, I think there's more to your question. So I would strongly urge you to set up a consultation and let's talk more in person as to what your situation is. For example, I don't know what that passive losses look like. Is it 100,000? Is it 200,000? Is it $1 million? I mean, are we talking about a small residential property you have? or do you have an apartment complex? I mean,
Plus,
what?
it's not only passive loss, it's also how many investment you have. If, for example, you might have a lot of properties, maybe 10, 20, maybe you have single family homes, maybe you have townhomes, you have condominium versus commercial buildings. So there are a lot of things. One way is you can use the passive loss, you can sell one of those properties. You can get the gain set up, use that loss to set up the gain. So you can do a group classification, you can select, you can do election, and you can do use it. So there are ways you can do it, yeah.
Yeah, and I think that's a good one because sometimes people don't sell the properties because of capital gain problem.
Right. But
But
they ignore that loss.
yeah, and they might have, and most people might not even know. Like if I were to ask you today how much collective, like total bucket of those losses you have, I think most of you wouldn't know that,
Yes.
right? You might
But
not.
they don't look at the Form 85
Yeah.
they do. They're not aware of it.
Right. So that's what, anyhow, that's my 2 cents on that. So next one is actually, I love this question, Sanjeevji. This is a really good one. This one is related to insurance. So, and we can talk more details about it, but specific question is, I want to borrow $200,000 from my insurance policy to buy real estate. What are pros and cons, tax consequences on that loan? So what he's talking about is he probably purchased a life insurance policy. Hopefully it's a whole life policy, not really a index based policy, but it could be either one for that matter. And he has substantial amount of cash value. He put a specific number of 200,000. So I'm assuming his policy probably have at least 300,000 or maybe $400,000 in cash value. And now he wants to borrow the funds from the policy and then maybe use that money to put as a down payment on a real estate property, or maybe he's buying it out cash in some other area. I know in California it's going to be impossible to buy for 200K. So that's what's going on basically. And he was wondering, hey, is that a right thing to do? Are there problems with it? Are there any tax strategies around that? So I think it's a great question. So let's break it down. Now, first of all, insurance, generally speaking, the way people sell insurance is they sell it with all kind of marketing tricks, meaning they will try to prove to you that why it is a great product. But very rarely we see somebody mentioning problems with that product, like what kind of issues you can run into. So my first advice to you would be is first get your policy reviewed. And let's take a look at that and figure out, if you borrow the money, what is your probability of getting in trouble with the insurance company? So that's where I would start before even looking into anything else. Because if you borrow the money and your policy lapse, I mean, you can be, first of all of a sudden, you could be responsible for taxes of any growth that you had in a policy. So that could be one consequence. Number two, your policy can lapse and now you lose all sorts of benefits that you have attached with it. So before I do anything, now, and I want to make it clear because oftentimes people kind of assume that things are guaranteed in the policy, but that's like way far away from truth. Everything is, there are like a lot of like little parts to the policy that can have a significant change. So enough about that. Before you do anything, reach out to me, let me review the policy, and I'll tell you, what kind of troubles you can get with the policy itself. So that's point number one. Point number two, if he borrows the funds from the policy, his specific number is 200K, he borrows the policy and he puts down the down payment. So I guess the first question would be is, technically it's a loan he's taking from the policy. Is that deductible as an interest because he's buying real estate with it?
That's a very good question, by the way. It's not only from policy. You can borrow from HELOC, line of credit for your primary home. You can use 401k money. We can borrow against your 401k money like 50,000 or 50%. People use that. So whatever money you borrow and you use it for real estate, that interest that you pay on that loan becomes an investment interest. Means it changes the nature of that interest expense. Now, if you're generating income from that investment, that is a deductible interest against that income. So, and there's no limit. There's no limit. Like we have in primary home, there's a limit on interest can be deducted only up to 750K of loan amount. Here, it can take $1 million borrowing, if you can borrow $1 million from your investments or cash surrender value, whatnot, if you borrow $1 million from that policy and use that interest can be 5-6%. Your $60,000 worth of that interest expense can be used to offset the income and create the losses which we just talked about.
So the simple answer is it can be a great strategy.
Yes.
You can get some write-off for the interest that you're paying actually technically to yourself, because that's where the money is going, to your own insurance account. So you make money that way. And as you guys already know, the proceeds, in most cases, I wouldn't say always, but in most cases, proceeds that you get from the insurance company are tax-free anyway. So you get a deduction here, and your money is making money there. And when you eventually get the money, it's tax-free. So it's a win-win-win situation for you. So the strategy works. There's no problem there. But like I said, it may or may not be the right thing to do depending upon the policy.
So you rightly pointed out the insurance agents, they sell very wrong products. And that's the fear that creates in the mind of everybody that, hey, why this guy is selling this product to me? They don't realize the importance of having an insurance policy as part of your tax planning for the future. Not only when you retire, if you die, how the beneficiary will take that money out. So it's very important area of planning. You cannot ignore it just because the agent is. Be careful of the agents, but you have to make money from money. Don't make insurance company make money from you. But there are ways you can make money from them. But you have to be careful, and you need to connect with a proper insurance professional and see how this thing is. Don't ignore that aspect.
Sanjeev is right. It's a extremely important part of your overall planning. But unfortunately, Sanjeev, I review insurance policies almost on a weekly basis. Very rarely I will come across a policy that is actually good. In most cases, somebody would be lucky to make any money off it. Now, I'm not talking about death benefit. I'm talking about your policy making you money. Very rarely that actually happens. So I'll give you 2 tips on that. Before you buy it, just get it reviewed. Reach out to me, show me the policy. Say, Deepak, can you give me your 2 cents on it? Does it make sense or not? That's number 1. Number 2, if you already purchased the policy, you still typically have at least 30 days, depending upon which state you're in. And they call it a lookover period. And within that lookover period, if you decide to cancel it, you don't get penalized. So that's a second tip. Number 3, sometimes I see people who are stuck in a bad product. They purchased it 10 years ago, 5 years ago, and it's just not doing them any good. But they're afraid of fees, so they keep putting more money into it.
Yes.
That's a big one. Look, once you understand what are the limitations for that policy, now you need to start hedging against that.
Yes.
What else can you do? Like, don't just keep randomly. That's a bad thing to do to begin with. You lose a lot. But don't keep putting more money into it. Just look it over and let's come up with a strategy. How can you utilize it? Sometimes I see people who are oversold on policies. Sometimes they're undersold on the policies. Sometimes they're taking too much money out. Sometimes they don't even understand how to use the policy. So anyhow, that's a whole different conversation. But
so as a tax professional, I look at the policy as a valuable asset, not because it gives me insurance. It gives me a safety, a security in the future. So for example, if I have to fund my kids' education, college education, I can borrow money against my cash surrender value, and the interest rate will not be 7-8%. It will be maybe 5%, maybe 6%. But then I also get the dividend from the insurance company, which they declare 4%, 5% in a very conservative manner. So my offsetting is there. So I get the money to pay off my college expenses for my kid. So I'm just giving an example how one can use that policy, and it's a valuable asset. I cannot just keep saying don't ignore that one.
All right. So I hope that answers that one very clearly. But you're welcome to reach out to us, and we can definitely talk more about that. Another question here is, so I have multiple LLCs. So whenever somebody says multiple LLCs, I feel like somebody sold up some sort of package, some sort of deal, because why would you create multiple LLCs to begin with? But maybe there is a reason. We don't know. So don't just go create LLCs just because you think that's the right thing to do. There are a lot of ins and outs to it. And now I'm in the process of setting up a brand new LLC, and I'm thinking to use it as a management company. So we see that over and over again. That way I can write off some expenses. So what he's really talking about, let me break this question down. You might be saying like, what's the problem with it? The problem is what Sanjeev was discussing earlier, right? Active versus passive. He's referring to properties, that he has multiple properties, and now he wants to set up another company as a management company to manage those properties. Now, why does he want to do that? He wants to do that because losses that are generated from these real estate properties are all passive, like Sanjeev said. So if he has any expense, he cannot take advantage of that. But if he sets up a management company, that management company will be now actively engaged in a business. That means any losses that he generate out of that management company, he can use that as a write-off. So what essentially he's saying is he's gonna pay his management company from these LLCs that will create some revenue for the management company. And now management company will show some expenses. So this management company zeroes out at the end of the year and he's able to get some tax-free income out of it. That's what he's referring. Once again, the question is not clear. Anyhow, I love the strategy. What's your thought on it?
Yes, so like coming to LLC, why multiple LLCs are created, there's a series LLC, we call it Delaware Series LLC, where people have properties listed under different LLCs, and one LLC, main LLC becomes a holding LLC for those, but it works only for Delaware. It doesn't work for California state. If you hold multiple properties and you have series LLC established in Delaware, and there's a holding company having the control of all those LLCs, it doesn't work for California. California still end up paying it per LLC $800 and need filing returns. So it doesn't work for California residents. Coming to that question on the LLC as a management company, instead of doing LLC as a management company, do as corporation. That's a good strategy. Yeah, of course, it's a good strategy, but then you have to also document what you. So management company cannot overcharge the real estate. So what is management fee? Management fee is 7% to 10%. That's the fair market value of the rental income. That's what a management company charge. You cannot charge 15%, 20% and put it as corporation LLC and just do your regular expenses like telephone, travel and whatnot. You can't do all those things. So just take that the reasonableness of that income, 7% to 10%, put in as corporation, run some payroll, do some 401k planning, do some expenses, reasonable expenses, not overboard, not. You don't need traveling for management company. Don't book travel expenses there. So be careful. But it's a good strategy. But talk to a professional to get it right.
So I will add another couple pointers into it. Honestly speaking, it might also be a good idea to have a C corp, depending upon what kind of
Liabilities and that.
you might have going on, right? For example, if you have a healthcare cost, you won't be able to deduct that on S corp, but on C corp you might be able to take advantage of that. So once again, very generic advice based on what we understand. Until we talk to you, have a better understanding what your income looks like, what your expenses look like, what kind of income it is, where it's coming, where it's going. It's hard to predict.
And just don't form LLC because your friends or you learn on the internet. Maybe LLC are good, maybe LLC are not good. There are other entities like C corporation. Of course, people don't like C corp, but there are certain ways you can use the C corporation. S corporation works in certain ways. General partnership also works in certain ways. So just be careful. Get the right advice before you enter into any kind of entity setup.
Yeah, and I think what's happening, Sanjeev ji, is internet obviously made it super easy for people to get information, and not just internet. In matter of fact, even formation has become quite easy these days.
Because they can Google online. They say they go to different websites. All the incorporation. They ask some sample questions. They don't understand the situation of a particular person. And I've gone through those questions myself on different websites, and they just say, okay, LLC is good for you, or else. No, that's not the answer to that question. Depends upon your scenarios, your requirements, your situation, your status. So yes.
And since we're talking about that, Sanjeev ji brought up another good point here. Is let's say if you have multiple LLCs. So let me ask you a question. Why did you set up that LLC to begin with? And if you understand LLCs, then most likely your answer going to be for liability protection. You want to protect yourself. Just by having an LLC would not necessarily provide you a liability protection. There are a lot of other requirements along with it. And if you're not following all of those, if that LLC is not structured properly, if there are no proper rules and regulations how you operate that LLC, that liability protection might not exist to begin with.
Yes, you treat the LLC as a piggy bank and commingle your personal funds and with the LLC using it when you what you like it. Now, LLC does not give you protection, and the reason why people form multiple LLCs, the reason is not the internet. I think the attorneys has to be careful with that too.
This guy had an LLC, and then he was paying his mortgage payment from his LLC and claiming that as a deduction as a business expense.
I review the return for a lot of clients. I find so many interesting things on those returns.
Yeah. So, when you claim expenses or deductions, it's creating two problems for you. Number one, you will probably most likely get in IRS trouble. If not today, maybe tomorrow, because habits don't change easily.
IRS don't might come in once in 10 years. Just one thing I want to get payment, but very normal thing that I see is travel expenses.
Yeah.
Going to India, going to any country, traveling to taking a vacation. Why you need those expenses when it relates to real estate? When you're doing a management of a real estate,
Yep.
it doesn't make sense. It doesn't make sense.
I mean, you can report anything, but most likely that will get you in trouble. That's number one. The entity that you created has almost no value because you pierce your corporate veil the moment you commingle your funds. And again, I don't want to talk about that today. It's a topic for another day because that's going to take another 2 hours. So I'll skip that. But I think at least that answers your question. Sanjeevji, the last question I'll take, and then we'll let you go here. This one is about flipping a home. Flipping a home simply means is they maybe purchase something that required some work, they fix it up, and now they want to sell it. So that's what they're doing. It says, hey, look, it takes me almost 6 months to flip a home. Can I do an accelerated depreciation? So once again, accelerated depreciation was very popular 2 years ago. Not so much today, but it still has value. What simply means is, let's say you have a property and it generates, let's say, $50,000 in depreciation. So you have a property. What you can do is you can get a study done. We call it cost segregation study. And in that study, a professional will say that, okay, out of this overall building, 25%, maybe 30%, maybe 20%, depending upon what kind of building it is, you can write it off within the first 5 years. And that depreciation amount, you can claim right away on your tax return. So 2 years ago, it was 100%. And then last year was 80%. This year it's 60%. It might go back to 100%. We don't know. But as of today, it's 60%. That's what he's talking about. That hey, I built a building or I fixed up a building. Now I want to do a cost segregation study on it, take those losses, and because he's flipping, more than likely that's an active income to begin with. So that can offset his income. The problem I see with him is if you're going to flip it, then what's the point of using depreciation to begin with? Because you're going to have to recapture it right back. Right, Sanjeevji?
Yes. Recapture, and moreover, it's not sold within a year. It's not sold after 1 year. It's sold within that year. It's an inventory for that business because you're flipping it. So it doesn't make sense to do depreciation. It doesn't make sense to do cost segregation to get accelerated depreciation. So my advice will be don't go that route. Just maintain all the cost, all the improvements that you're doing are anyway increasing the basis of the property, and you can deduct it from the capital gains. So why to depreciate it?
Yeah, and I'll tell you where this idea probably came to this gentleman's mind. So what's happening these days is a lot of people, probably one of the two ways. A, the social media, everybody wants to get views, clicks. I mean, I want more people to watch our videos as well, because more they watch, more likely they're going to call our office for consultation for tax work and whatnot. So I love social media. It works. However, I can get more clicks, more likes if I make bold statement. For example, if I title this video, how to sell a property for $1 million and not pay any capital gain.
Of course, you will get the most clicks.
I'm gonna get a lot of clicks, right? These people talk about this cost segregation. They want to get more attention. Second reason is people want to sell. There's new word being around, tax strategist. A lot of people claim themselves to be tax strategists. Why they do that? Because they want to get away from regulations. What they're saying is, look, I'm not licensed by anyone. I'm not a license by the state, the federal authorities. I just know stuff. I'm happy to share that knowledge with you, and my title is strategist. I'm telling you a strategy. To tell you the strategy, I'm going to charge you $10,000, $20,000, $30,000. I'm going to charge you that much money to tell you about a strategy. What's the strategy? Well, strategy is cost segregation. Go there, do it this way, we'll connect you to the people. Well, guess what? You're going to pay that guy, then you're going to pay the cost segregation guy, then you're going to pay the tax guy who is going to tell, if he's the right tax guy then or gal, they will tell you that's not the right thing to do. Now, guess what? All the money that you spent on buying that course, all the money you spent with the strategist, with cost segregation study, it's all gone. You can't get it back. They're not going to refund you the money. They're not signing the returns, so they're not on the hook. It's free money for them and putting you in a lot of trouble. So once again, go back to the basics. Reach out to a tax professional, somebody with license, somebody who's been around for a long time. Book a 30-minute or an hour-long session with them. It's not going to cost you thousands of dollars, a couple $100 at the most. Spend that money, get the right advice. Honestly speaking, you should not be even relying on this video because I don't have all the details. I'm just making a lot of assumptions here, and based on that, and maybe it is the right advice. Maybe I'm making all the right advice. That's my recommendation in that area, as usual. So anyhow, that's all the questions for today. I'm gonna ask them in a separate session with Sanjeevji, but he promised me he will give me 1 hour. I'll try to take this video and I'll break it down into smaller sections, so that way you can go back to your specific question and get that answer right away. If you're coming to Wealth Summit, I request you to register on sanjeevcpa.com right away. It helps us a lot. It helps us a lot because we can manage the resources so much better. Our job is not to organize events. We don't make money from these events. They're cost center basically. And if you don't trust me, you can do a simple math. How much you pay for the ticket, how many people are at the summit, go to the local venue, find out how much it will cost to host an event for that many people, and you get the answer. Trust me, it's not a money-making center. But by booking the tickets in advance, we're able to kind of manage everything. How many chairs I need, how many tables I need, how much food I need to order. If I need to book another hall, it can kind of make my life a lot easier if you just kind of book it in advance. So that's my request. Tickets are live. You just go to sanjeevcpa.com, click on the banner for Wealth Summit. Now, we also have a webinar coming up in first week of
September 4th.
That is specifically focused on real estate. So we're going to talk about a lot of strategy with real estate, both US-based real estate as well as foreign. So if you have real estate in other countries, you can benefit from that as well. So that, again, the webinar is completely free. If you want to ask a tax question, once again, generic advice, nothing special, nothing like very unique to your situation, then just reach out to me. If you don't know how to get a hold of me, go to our website, sanjeevcpa.com, call the office 510-825-7563, and just ask them, hey, I want to send this question to Deepak. They will connect you with me, or they will copy me on your email. That's it for today. Thank you so much, and I look forward to getting more questions for you and getting those answered by Sanjeev. If you have any tips, suggestions, how we can improve the Wealth Summit this year, please reach out to me and let me know. This is your time. After October, it will be all set and you get what we have planned. But if you have any ideas, September, August, that's your time frame. Okay. Sanjeevji, thank you so much for your time today.
Thank you, Deepak, for doing this. Like Deepak rightly said, if you are looking for any kind of options, or you look to hear something different, do connect with us for the Wealth Summit. So we will take that into account when we do our presentation. We'll make sure that these things are taken care of.
Now, Sanjeevji, people who want to set up a consultation in next couple of months, what does your timing looks like these days?
So timing is there. They can call my office, but my slots get filled up very soon. So it's based upon who comes first. So I would say a week or 2 weeks.
Once again, to book an appointment with Sanjeev, you go to sanjeevcpa.com, and there is a link there. Just click on that, fill out your information. Office will reach out to you right away. If you are during business hours, you can call our office 510-825-7563, and just press 0 to reach out to the front desk, and they can set up the appointment for you. All right. So thank you so much, guys, and I will look forward to seeing you at the Wealth Summit.